to the Intelligence Global Energy Outlook Forum with 20 sessions over 12 hours, bringing crystal ball forecasts for the year ahead by the top 50 energy market analysts from Shanghai to Houston. My name is Andy Critchlow. I'm the head of news in EMEA at S&P Global Commodity Insights, and I'm delighted to be joined by a very experienced and knowledgeable panel. I'm going to leave it to my panelists to introduce themselves, but to many of you on this call, listening in, looking at the webinar, Dr. Adi Imsirovic, Neil Atkinson, and Dr. Iman Nasiri. These are personalities in our markets that need very little introduction, but I will leave it to them to kind of just give us a little bit of a taste of kind of what they do and their background. So, Dr. Iman, if you can just share with us, currently your role and where you're based, etc.
Sure. Thank you for the intro, Andy, and thanks, Gulf Intelligence, for the invite. I run the Middle East operations and serve our clients in this region, oversee the research for the consultancy FGE. In fact, this 2024 marks our 40th anniversary, so I'm proud to make that announcement. I'm based in Dubai, but I do work with the rest of my colleagues in other offices to form a view on the oil and gas market fundamentals.
Great, thank you. Adi, if you can just introduce yourself as well, thank you.
Thank you, Andy. Yes, I'm a director of Surrey Clean Energy and a senior associate with CSIS. Interestingly enough, I'm just kind of hopefully finishing a book on the oil transition. So yeah, I think that's all happening in the next few years. So I look forward to this discussion. Thank you.
And Neil, over to you.
Thanks, Andy. I'm Neil Atkinson. I'm currently working as an independent energy analyst. My most recent full-time position was as head of the oil division at the International Energy Agency here in Paris. And prior to that, I have about 40 years of experience in a range of entities, including Petróleos de Venezuela, Platts, the Oxford Institute for Energy Studies, and others. And I'm looking forward to participating again this year in this event.
Great. Well, we're going to look at European markets today, but I think it's great to frame this in where we see the global market for crude specifically going in 2024. S&P Global Commodity Insights, we're anticipating a market in excess of 103 million barrels a day in 2024, which will be a record. Obviously, the bounce back from COVID and the destruction to demand, which was caused by lockdowns, that's now completely through the system. But lots of geopolitics, lots of risk in the market, lots of uncertainty still about economics. So I want to come to you, Dr. Iman, first, and just can you kind of give us where you see, total demand, the health of the market heading globally as we start 2024?
Sure, thanks, Andy. Yeah, so as we just started the year, I want to say that last year we had a picture, the FGE of 2.5, 2.6 million barrels per day growth year on year. That was considered as a healthy demand, but a lot of that was the final kind of bits of COVID recovery. So we consider the COVID recovery basically complete now, and we return to more kind of normal pace of growth this year. For 2024, a little bit of maybe residual jet fuel recovery from COVID is left, but with that included into our forecast, we see 2024 demand forecast of in excess of 1.5 million, maybe 1.6 million barrels per day for 2024 as a whole. However, as everyone on this panel knows, knows, and those who follow the market, there is a seasonality with the demand kind of going up and down during the quarters. And putting that next to our current supply for non-OPEC growth, we see the colon OPEC Plus basically pretty much in line with the current plans announced by OPEC Plus for first quarter. And in fact, if they continue to roll that over into second quarter, we'll have that fairly well balanced during the first half, but then there is a room for improvement in the second half, and that basically brings us to a balanced market for the year. And we think the year with these first half kind of all the cuts in place, and second half perhaps room for some relaxation, at least of the last latest cuts announced in November. The year will be another year in two half with lower perhaps prices in the and supply in the first half, and higher demand prices and supply in the second half. That would be a 2024 outlook in at one glance.
So, Adi, do you share Dr. Iman's optimism there? Really
No, Andy, I don't. I think Dr. Iman is absolutely right. If you assume demand numbers as per OPEC Secretariat, I'm not quite sure that I would agree with them at all. I think they differ from EIA and from IEA and from a number of other forecasts. So I would probably expect next year demand to be a lot less. I think probably not more than 1.5, 1.7, somewhere there, million barrels. If that's the case, pretty much all of the supply will come from non-OPEC, which means that OPEC will have to continue with their cuts throughout the year. In fact, it's probably worse than that, because the situation with so-called, 3 countries outside the OPEC quotas, I think they're very likely to produce some more, maybe up to 300,000 barrels a day, which means that the call on OPEC will probably be negative, minus 300,000 or 400,000. Obviously, these are the assumptions. I don't disagree with Dr. Iman based on the assumptions. I think just my assumptions are different. And there are a number of reasons for that. I think we can go into this a lot more. I think this year is going to be torn between 2 big determinants of the oil markets. One will be geopolitical, which is potentially quite bullish. And the other one, which is fundamental, which is not looking very clever at all. I think particularly the situation in China, we can go later on into more details. The whole macro is the key to setting up flat prices, and I think macro situation is not looking good at all at the moment. I think in the next just to give you an example, flavor, in the next few weeks, between United States, UK, Europe, and Japan, because of debt problem in all of these regions, we are going to see floating of some $2 trillion worth of debt that somebody has to buy, okay? Which means that all those hopes of swift reduction in the rates of interest are probably misplaced. And we know that high interest rates don't mix very well with higher oil prices either. So from that perspective, pure macro perspective, I think it's not looking very bullish at all. However, on the other side, again, I think we'll go into more details with on that. You see geopolitical situation from Taiwan to various elections, to the situation in the Red Sea, Palestine, Ukraine, potentially quite bullish.
So a lot of headwinds there. I'm going to come to you, Neil, next on this question, and the same question. Where do you see the market kind of landing in 2024, given these questions around the trajectory of global economies? And I mean, as well, one of the things that I find interesting, especially in the European context, is global context. I saw a figure, something like 2 billion people are going to go to the polls and vote in 2024 in various general elections. We're going to have a big one here in the UK, possibly at the end of the year. Of course, the UK isn't a major kind of pull factor on global demand, but it is still a significant industrialized, developed economy, and all this political change potentially could have a slightly destabilizing impact on markets. How do you see that panning out?
We don't have elections here in France, sadly. The last democratic exercise I participated in was to vote to ban rental e-scooters back in April. And I'm looking forward to visiting the UK later this year to vent my anger at the polls. Now, Adi made a very important point about the macro picture and his contribution. Some data I was looking at recently from the International Monetary Fund, who are not necessarily any better at forecasting things than anybody else, where they did note that global growth in 2024 and indeed in 2025 is likely to be significantly below the 10-year average that we saw up to the pandemic. And that's an important signal because, as Adi says, the macro picture governs everything. Everything arises from it. So we have a gloomy picture. On demand, I find, for example, OPEC's outlook, not just for 2024, but further into the medium term, to be almost incredible. And I think that they are talking their book. And I think that also applies to my former colleagues at the International Energy Agency. And neither agency, I think, is really helping us understand markets properly, because I think they are talking their political book. My own instincts as far as oil demand in 24 is concerned is that we are likely to see round about 1 million barrels a day. But if it is to be different from that, it is more likely to be the upside than the downside, because demand has tended to surprise. Perhaps I was infected by my years at the IEA, but demand has tended to surprise to the upside rather than the downside in recent years. So I think we have underlying solid demand growth in 2024, and indeed will be the same in 25. But crucially, as Adi said, with the expected increases in supply from the non-OPEC countries, which again I believe will probably surprise to the upside if they change from the current outlook, the market is well supplied, and there is, frankly, I don't think, much room at all for OPEC plus countries in 2024 to take back any significant market share. So I think we're going to be trading in, for most of 2024, subject to geopolitical implosions, which none of us can accurately foresee, in a range of something in the region of $70 to $85 of Brent for Brent, something like that, because it will go up or down. But the significant upside, people talking about $100 a barrel and other fanciful figures, forget it. That's not going to happen.
So one of the trends that really developed, obviously, in 2023, one of the big narratives in the oil market, and it started in 2022, invasion of Ukraine, international response, sanctions, price cap on Russian crude. You just look at the chart and how those Russian volumes, Urals, have been displaced, obviously, out of Europe. And those barrels have headed into Asia predominantly. And, I think it's setting up a very interesting dynamic going forward in terms of this market share battle, which is going to happen. And maybe is already happening between the core OPEC nations exporting out of the Persian Gulf and Russia going forward for domination of these growth markets in Asia. We're talking China, India, because demand growth as we head further into the energy transition story out to net zero 2050, any demand growth in oil markets is going to come out of Asia, right? So how do you square that, Dr. Iman, with OPEC? Do you see this relationship between Russia and those core Gulf producers becoming more strained because of that dynamic of market share battle that's been created by so much, Urals flowing into those Asian markets?
I'll tackle this question, but let me briefly clarify my comment on the first one, and I appreciate the comments by Adi and Neil on that. The demand growth, what we have is basically a very detailed kind of a country level bottom up approach, and we get to 1.6, 1.7. It's not OPEC sector demand growth of 2 point something, so it's our own forecast. I was just referring to FG's demand, which is, I think, in line with what you said, Adi, of 1.5, 1.6, 1.7 at best, which is, again, as Neil said, perhaps if we have a surprise to the upside. So that's that. Also, I agree with both of you that most of this demand growth will be met by non-OPEC supply. Hence, call on OPEC for the whole year versus last year, year on year, is maybe zero, maybe 100 kbd plus in an upside to the demand more and less. But we don't have a flat OPEC plus supply. So they have cut first half or first quarter, and we're saying that perhaps they may roll over to the second quarter. For that to be offset, that could be unwound for the second half, but it doesn't mean that they're going to add more than what they're taking out. So it is, in a way, suggesting that perhaps call on OPEC plus year on year is flat to a little bit less, depending on how much they put back. But it's just means that what they are taking out of the market first half, they could put back in a seasonal kind of demand second half. And depending on how much demand surprise we have to the upside, it could be more. So that's that. And the second, about the market share, I believe the trade reshuffle has proved, for the sake of market kind of balance, has proved to be effective despite the price cap and other kind of buyer or market unilateral sanctions on buying Russian crude, has proved to be effective in a sense that the old kind of suppliers in Asia have managed to reroute some of their supply to the west of Suez markets. And overall, I don't see that as a threat to market share or unity of OPEC plus member countries. I personally don't think that the situation this year will be much different from 2023 in terms of the market response to the Russian barrels reshuffle against the OPEC plus unity or collaboration.
Adi, if I can come to you next on that, I mean, do you agree with that sentiment that Russia and that those core Gulf OPEC producers can kind of coexist in that Asian market, especially as we go towards the end of this decade when things are going to look tighter because energy transition does start to kick in and the policies to actually push down on demand growth you would expect to take effect, and are we going to get more of a dynamic of market share battle, which OPEC has previously had problems with?
Yeah, I think we definitely are going to see that dynamic eventually. Again, there are like two forces working against each other here. One is the fact that it's taken Saudis, let's call it Saudis because they're the leaders of the cartel. It's taken them decades to get Russia, one of three biggest producers in the world, on board. And it's very hard for the Saudis to let that relationship go. It's just taken so much time and hard work and money, especially in 2020, flooding the market to actually make that point. So I don't see that relationship falling apart very, very quickly, especially because it suits Russia extremely well. Being at war, they need money, and they will do everything to talk to say the right things and actually keep on exporting as much as they can. So that's basically the Russian strategy and has been all along. And the Saudis and the rest of OPEC, as long as Russia talks well, will pretend not to see anything. And the fact that Russia's really cut relatively little. I mean, there is some evidence in November, December of lower Russian exports, but I want to see the actual numbers over a longer period of time, simply because usually that time of year, for example, weather plays a very important role. Novorossiysk gets closed for several days. So that will skew the data quite a lot. Plus, you have a relationship between crude and products because Russia has that flexibility depending on their throughput in the country. So I think that relationship will continue until the situation gets tougher. And I hope the economics are not such that it gets that tough, but everything is pointing towards US exports continuing to grow. Yes, there is a diminishing rate, but they are. I mean, it's US exports are just incredible. If you look at it, US producing more oil than any other country ever in the history of the oil industry. And it's ongoing. Now we've got China now using shale technology and finding some new shale oil out there with Guyana, with Brazil and the others exporting more. I think OPEC is going to be in a very, very difficult position. On the other hand, and now we are probably going past this year, 2024, but we've mentioned 2025 as well. Yes, possibly in 25, maybe even 26, we'll see demand growing, but there's a huge pressure to reduce emissions. And I think we're missing a big, in this industry, in our industry, we tend to miss this big elephant in the room, which is the climate change, which is not getting any better. We've had just the hottest year by far ever on record. I'm dreading to see what the next summer is going to bring in terms of forest fires and so on. And there'll be more and more pressure growing on the oil industry to cut the emissions, if not overall demand. EVs are going through the roof, growing exponentially. So I think OPEC is going to be in a very difficult situation, which eventually will mean that OPEC Plus will fall apart for sure. Eventually OPEC itself will probably get stronger, but OPEC Plus will fall apart because of those forces.
And we're going to come back to that subject as well in terms of in the European context as well about the energy transition and where we see European policies going over the next 5 years in terms of will governments be able to stick to fossil fuel phase outs? Will they be able to stick to transport policies to encourage EV use, alternatives to ICE vehicles, etc., or will there be a rowback like we've started to see in the UK, pushing back the phase out on the sale of ICE vehicles, for example? But we'll get to that question next. I just want to come to you, Neil, on that. And Adi, you raised an important point there. US production liquids in excess of 21 million barrels, astonishing. It seems that the nightmare scenario for OPEC, a resurgence of US oil production, this dynamic that caused OPEC so many problems in the middle of the last decade, that it's come back. I mean, how important do you see? How do you see that playing out, Neil, over the next year and beyond?
Well, it's not just a resurgence of a few years ago. It's a resurgence of what happened in the 1980s.
Right.
When oil demand fell for 4 years in a row or 3 years in a row, the North Sea came from almost nothing to 3.5 million barrels a day by the mid-80s, I think, and then more later on. So they have been here before. They were here also in the 2014 to 16 period with the first wave of US shale growth, and we saw what happened then when OPEC tried to fight for share. Prices collapsed. They are just going to have to suck it up. The US is now a massive producer, the biggest we've ever seen. It will continue to grow as per the commercial decisions taken by the companies operating in the field. There is no US oil minister, mercifully. And not only in the US, we will see continued growth in Guyana, which is a long-term investment play from the likes of Exxon and others. And we will see continued more measured growth in countries such as Canada, possibly Norway, and indeed in a handful of other countries you can think of, perhaps even including Argentina as a shale oil player. So looking for the next few years, there is lots of supply likely to come on stream from the non-OPEC countries. And that places the OPEC Plus countries in a tricky position. But the only solution they have is to suck it up. This is the fact of life. Demand, although it's going to continue to grow, and I think it will grow more for longer than some of the peak oil enthusiasts would like to think, there is still going to be enough supply to meet that demand for the next few years. And just quickly, because I'm conscious of the time here, as far as I am not in the camp that believes that peak oil demand will come quickly. And one of the reasons for that is if you look at the per capita consumption of energy as a whole, but let's look at oil in countries such as India. the African continent and other developing countries. You've got India using 1.4 barrels per capita per year. I think it's 21 in the United States and something like 8 or 9 in the European countries. Only 1.1 barrels per capita per year in Africa. Now, I'm not saying for a minute they're suddenly going to go overnight from current levels of consumption per capita to the levels we enjoy in Europe and in the United States. Of course not. Their growth, their energy growth will come with a lot of renewables contributing to it. Of course it will, but they are still going to be using over the next decade or so and beyond an awful lot more oil. And that is a reality. And, we can do, we can take measures in Western Europe and in the United States, which we are doing, and we are seeing growth in sales of EVs. There's no question of that. But the growth in developing countries is, I believe, going to surpass the savings that we make in the developed countries for some time to come.
Great. I mean, I just want to point everyone to the panel survey that we're running here. Classic oil market fundamentals of supply and demand will trump geopolitics and black swan events to determine direction of oil prices in 2024. Agree or disagree? I know what my answer is to that question. I think staying with you then, Neil, very quickly on that one of the interesting things about Europe and the European economy now is that actually net energy consumption in Europe has actually fallen, which I find fascinating when you look at that probably Europe is electrifying quicker than any other region in the world at the moment. I mean, has the age of oil ended for Europe entirely?
Well, we had peak oil demand in the OECD as a whole, I think in 2006, 2007, something like that. Was it 5? Okay. Yeah, I was more than 15 years ago, getting on for 20 years ago now. And that's, of course, partly due to, deindustrialization in Europe, vehicle efficiency standards and all the rest of it. So, we've already hit the peak. And I can't remember off the top of my head where we stand today versus the peak, but somebody may know that number. So, Europe will continue to do what Europe does to electrify where possible, although there are signs of rollback in certain markets in terms of incentives given to purchases of EVs and various other things such as heat pumps and solar panels on roofs. So Europe has its own problems, which means it may be reducing support for electrification. But it will still continue along that path because that is what the elected leaders are currently promising. But I come back to my point that developing countries have still got an awful lot of fossil fuel-led development to come.
We did earlier last year. We did see, and this was partly in response to the displacement of Russian barrels. We did see some barrels coming through Suez from the Middle East, from the Gulf, into Europe, into some of the Eastern European countries for the first time. Do you see? And then we saw, in reverse, you saw diesel flows going into Brazil. Do you see more of these sort of gyrations in flows of both products and crude being a factor in 2024, Adi?
Yes, I mean, what was been happening is obviously we've had a lot of, for example, Merben going into Europe. But what's also been happening, I've just looked at some numbers for the last 2 months. Now we've got, as Neil rightly mentioned, Guyana, for example. Guyana is really peaking, and Europe, for the first time in December, imported, I think it was about, off the top of my head, just over 200,000 barrels a day of Guyanese crude, which is medium sweet, is actually perfect substitute for the Urals. In terms of diesel that you mentioned, of course, I think some new market. Russia's been working extremely hard. Some of my old colleagues actually told me they've been working extremely hard to place the barrels into South America and Africa, because obviously they're struggling. And I think all this STS via Turkey and elsewhere is reaching the limit, because obviously Russian diesel goes into Turkey, gets put on another ship and goes back to Europe as Turkish diesel. So yes, the flows are really interesting right now because we've got also quite a bit of US crude has been going to Asia, as we know, but now because the shipping costs, partly as a result of the Red Sea situation, have made it very, very uncompetitive. So you've got more Middle East crude and West African crude going that way. So I think as we are going to see volatile market, we're also going to see these gyrations change quite a lot in line with shipping, in line with a lot of tightening sanctions, for example. It's still an open question, and I'm glad we leave it as an open question, because what is US going to do about, Venezuela, Iran, and Russia? I have no idea, because on one hand, there's a pressure to be tougher on these guys. On the other hand, Biden doesn't want gasoline prices to go up. So what we've been seeing in the last few months is basically a fudge, somewhere in between, pretending to be doing something, but actually doing not very much because we want to see the oil flow. That's a hard one, and I'm glad we kind of left it out without detailed discussion. So yes, we will see quite a few gyrations, which is something which is excellent for the traders. That volatility in the arbitrage trades, I think, is exactly what traders like.
Yeah, absolutely. I think the one thing that we can certainly say about 2024 is that there will be more volatility, and of course that does provide trading opportunities. Interestingly, the answer to our survey, 95% of respondents there agree that it's going to be market fundamentals that are going to be really driving prices, not the geopolitics that we've seen. I think that's fair. I would agree with that entirely. I think that we're out of time now, gentlemen. I think that's been a great discussion. Top of the hour there. Just to end things, I'm just going to ask each of you just very quickly, what your price forecast would be for the rest of 2024, starting with you, Neil.
Volatile year. It's going to move around 70 to 85 for Brent, averaging something like 75, 77.
Great. Adi.
$80, nice and round number with a lot of volatility. I agree.
And Dr. Iman, I think you mentioned it, but it seems that you'd be similar ballpark to Adi and Neil there.
Yes, we have it just below $80 for the average of the year, with first half 76, second half 82, average of the 6 month.
Great. Well, thank you very much, gentlemen, for your time. I've really enjoyed that conversation. And thank you, Gulf Intelligence, for hosting this session. Much appreciated and much needed.
Thank you.
All the best.
Bye-bye.
Bye-bye.
Thank you. Bye.